Welcome, everybody, to our webinar on how to successfully invest in multifamily real estate. We're great. We have a great guest here today, Eric Doyle. We're going to tell you all about Eric. He's got a great presentation for us tonight. And I'm Sam here with Affluence Real Estate Group. A little bit quickly about myself and us. We're in the Waterloo region. We help clients buy and sell residential real estate, help them scale their portfolio, and build financial freedom in real estate. Been in the business about 8 years, and we have a definitely systematic approach. And we've been featured on the Wine and Real Estate podcast, as well as presented on the Right Club as well. Eric is a dedicated real estate professional, specializing in commercial, multifamily throughout Ontario. He's an investor himself. He's definitely dedicated in investing strategies and how to navigate and help his clients. His team and himself own hundreds of doors and helped hundreds of clients buy apartment buildings, multifamily, and investment property for their criteria. Eric and Elevation Realty are on a mission to empower their clients to financial security and generational wealth. Through strategic real estate investments, Eric has helped hundreds in achieving remarkable results with real estate investment and multifamily portfolios. And he's also been featured on Andrew Hines' podcast, proving his commitment to himself and others in that great sector of real estate. So Eric, tell us a little bit about yourself.
Yeah, so I started originally in residential real estate as an investor before I became a salesperson or realtor. I really didn't want to become a realtor at first because I thought it was all about, helping people find their forever homes moving, and that didn't really appeal to me because I was realistically all on the investment side. Met Dylan Suter through Stefan Arnio. He passed away, unfortunately, but he was one of our coaches. Dylan took me on his team. I joined as a real estate agent, but I work exclusively with investors between, I would say, flips to 4 unit in the first couple of years. And now I've moved completely into commercial. So it's generally 6 units. And we recently did a deal for 87 units. So anywhere along that spectrum of size, I have a lot of experience in. I was also, I didn't mention here, but I was also on the Right Club podcast. So we've been on multiple different podcasts as guests together.
There you go. We're with famous Eric Doyle here. It's awesome. Thanks so much for sharing. So we're I'm just going to go briefly over this, and then Eric, you can chime in on what you any add-ons here as well. So why invest in multifamily? So capital preservation, having your money in property like multifamily, you're using more of other people's money. So if you have a 15 or 10 unit building, you have 10 families paying down that mortgage and that debt, that good debt, and you have fewer expenditures. Single family, you have one income coming in. If one tenant leaves, you're done. You have you have a lot more risk. With multifamily, you have more income coming in and less expenditures. One roof, one boiler, that type of thing. More predictable values. So single family is definitely predicted on emotion of last year. We all know when the market was definitely a lot higher. The values are all dictated by emotion on that time of sale. With multifamily, you're looking at it based on net operating income, which Eric will go into a lot of detail with you on. And that's just the income of the property that it's bringing in per year and per month as well. You can increase in value, less zoning issues, so less zoning challenges. You're not doing a single house to a triplex or quadplex conversion, fourplex type of thing. So you're not dealing with minor variances, red tape, and that sort of thing. Eric, anything you'd like to add on these points so far?
Yeah, so the first couple of points I really don't think could be overstated. Your risk is substantially less when you get into multifamily. It is a larger property, so it is a larger mental hurdle when you're putting a lot more capital down. However, like a single family home, a family moves out or a tenant decides not to pay, you have 100% of your income that you are on the hook for. If that happens in a 10 unit building, you are only for 10% of your income, whereas 90% of the rest of the properties are actually still paying you, and it really helps carry you through those problems that may happen, either tenant issues or vacancies. And the increase in value generally for these purpose-built buildings, if we are getting into it, that it can be correct for less zoning. in the event we are doing some sort of other strategy, as in we are taking maybe a mixed use building or a commercial building and changing it all to residential, it could be actually extra zoning issues. It really just depends you as an investor what kind of strategy you want to do. So if you keep a sixplex and it's under rented and it's in disrepair and you're just keeping it as a sixplex, then 100% there are virtually zero zoning issues if it's legal, and all you're doing is just which bleeds into the next point, predictable construction. I mean a 2-bedroom in Kitchener is the same renovation cost as a 2-bedroom in Hamilton. They're realistically the exact same size units, exact same size bedroom. It becomes a very predictable model once you get the number of bedrooms in the unit. So
and another thing too, I'd like to add too is, and I think you're going to attest to this, even small changes in savings of expenses or increase of income can drastically improve the value of that property, because you're improving the net operating income, so that improves the value of the property as well.
Exactly. So we'll go into that closer to the end, where I get into the cap rate triangle and how that affects the value of the properties. But we'll explain that more definitely down the line, so you guys can get a good grasp of it.
All right, take it away, Eric.
Perfect. So I just want to kind of walk through what we do at the Elevation Realty Network, just in case some people haven't heard of us. The structure is going to be kind of walk through how our team analyzes properties, how we see these deals, and then we will go through an actual live listing we currently have, dig down into the numbers a little bit, just so you guys can get a general idea of the acquisition, the strategy, the exit, and that sort of thing. So we'll save all the questions to the end, or we can contact you guys later for it. So the vast majority of our team is all investors themselves. So we're experienced investors, and we help fellow investors achieve their goals. As I mentioned earlier, I haven't really been, I would say, a regular realtor. I was an investor first before I got into this business. That's realistically all I'm kind of interested in the real estate space. So we have over 250 million personally invested in real estate projects. We have 100 plus multifamily projects that we completed, and we analyze around 1,200 properties per year. So we have a very robust back-end analysis team that we use to sort the good deals from the bad and bring them to the investors that actually need them and fit their criteria. So we say a little cheekily on the bottom, but we challenge you to find another team with the same level of investing experience and robust deal analysis, because it is almost impossible to find it. So commercial multifamily investing, I'm just going to go from a little basic, just because I don't know the experience of people on this call. I'm sure it ranges from people that had their first duplex into people that might have bigger buildings. But there is a lot more due diligence and process that goes into commercial multifamily, whereas a duplex conversion, let's say, some people are able to actually take that firm. There's no real appraisal. There's no environmental. There's no commercial financing. There's a lot less documents. It's really just residential mortgage based on your income. Unless you're financing some other way, but that's a tangent. So the main steps are the deal analysis, and this is a huge portion which isn't really present in the residential market. There's a lot of spreadsheets and a lot of analysis that goes into properties before we even get into them. As there's a lot of cost to acquire one of these buildings, we need to make sure it is a proper building for you guys, so those costs actually make sense to go through. So the vision is a huge thing. If you are buying an undervalued property, we need to know upfront, almost before the offer even goes in, how we are going to exit your capital out of this project. So the process, the network is a gigantic point, which I really can't tell enough. If you are working with someone who has not worked in commercial multifamily investing before, there is a gigantic amount of issues and hiccups along the road. They're all solvable, but if you do not have the network and the experience behind you, especially with the financing team and the analysis team, there's going to be a lot of potential roadblocks that can cost you a lot of money. And the deal flow is obviously extremely important. We're all here as real estate investors to actually purchase real estate. So if real estate is not being brought in front of us that matches our criteria, we can't really go ahead and buy it, right? So why work with Elevation? We are experienced investors helping fellow investors. We have a bunch of properties ourselves. I think we're up to 1,100 doors as a team currently. We have a broad network of specialists in commercial multifamily, whether that is financing, whether that's appraisers, whether that's inspectors, plumbers, up to full renovations of 50-unit apartment buildings. And we have an analysis and data team that's driven to finding deals for you that fits your criteria. If you guys are interested in the 6-plex and we're bringing you a 12-plex, you realistically have no real ability to buy it, and it's just not the best deal for you. So the deal pairing is a big part of kind of what we do. So the client roadmap usually along the journey. It's a bit more in tune than residential. We usually have a discovery call at first. This is where we get into how much capital we have for invest, what strategy works best for you given your timeline. If you have the construction experience, the ability to bring on potential asset management that will do it for you, if you have the time to manage the property, that sort of thing, so we can narrow down a criteria and a strategy that works for you. All along this process, we're also going to educate you guys. That's a big part of what we do as well. We're not just trying to bring you a potential property and say, this one's good for you, just trust us. We'll actually walk you through the strategy, how it's going to work every step along the way. Even after close, we still keep our clients. I still answer. One of my clients hits me up quite often, and he closed in October. So even though I have technically nothing to do with that deal, I got into this for a passion of helping investors, and I just continue to do that realistically going forward. So negotiation, obviously we're securing the best terms and the best deal for our clients, and that brings us to closing and the ongoing support that I was talking about. So this could be ongoing support through, I would say, like free mentoring / coaching, as well as we do work with an asset management firm that can go from anywhere to managing the construction to literally as soon as the offer goes in, all the way until they hand you the keys when the project's finished. It can be a completely turnkey solution for you. So the general 3-step process of how we analyze commercial multifamily deals: current property value, which is the net operating income, a cap rate, the dollar per unit, current cash flow. These sort of values are what we use to evaluate the current property. Then we bring it to highest and best use. So how do we maximize the net operating income? And the net operating income is as simple as your income minus your expenses. So that, depending on the property, that could be, let's say it's a commercial warehouse. And if we kept it as a warehouse, we can potentially rent it out to Walmart, let's say, for 10 grand a month. If we were to convert that to 20 residential units, that would be a lot more income and a lot more refinance value. So depending on the deal, this will be a lot different, but we try to find that highest and best use in order for you to get the best return going forward for however long you keep the project.
And just for our listeners as well, cap rate is the income over the value. So it's a ratio of the net operating income over the value of the property, and that's the percent cap rate.
Exactly. And that percent allows us to evaluate the building. Usually if you're seeing like a 10-plex, you can't, in residential, if there's a duplex beside a duplex, they're basically going to sell very close to the same. If there's a 10 unit right next to a 10 unit, they could have wildly different values based on the financials. So the cap rate is a valuation on how we can actually value a building without just doing a comparable analysis like in residential. And that brings us to the new property values. So once we bring it to highest and best use, it will have the highest value possible for you. And that is how we get and refinance the vast majority, if not all, of your capital out. And you can just keep doing this over and over and over again if you so choose. So this is just an example of a successful investor's power team. So in commercial deals, there is a lot of stuff that goes into this. So usually there's appraisals, which there are in residential. They are a lot more in depth in commercial. The inspections are also a lot more in depth. There's energy audits, depending on if you are going to CMHC MLI Select program, for instance. And that program, we can talk more in a further meeting, as that's a bit in the weeds. But if we increase the energy and the green efficiency of the building, the government of Canada will actually give us better financial terms. So that brings us to an environmental. Generally, this is necessary for any commercial building, with some exceptions, but that's completely not applicable to residential. So that's a whole different thing as well. Municipal experts, generally, if you are doing some sort of conversion, zoning conversion, there might be a bunch of other checks depending on the property. A lot of this is realistically very property specific, as they can have a wide range of issues or opportunities depending on the strategy. So the security, funny story, in Hamilton, we own a property. It's not in the best area. We have 24/7 security there constantly. It's something not a lot of people think about, depending on where you are actually investing. But that could definitely be a concern. So we have to budget now for security on this 60-unit building, as there keeps being issues and transients and break-ins and that sort of thing. So it's really nice to plan for all of this up front and have the budget for it up front, just so we know what we're getting into. But the core of all of this investor power team is you. Obviously, you are the investor. You are, the nucleus, the powerhouse behind the cell, or the mitochondria. So we have the finance team, which is extremely important, as I'm sure all you guys know, the real estate team to source the deals, and asset management, which can either manage your deals from start to finish or any sort of version of that between the two of you. So reach out to our team to elevate your investing journey. So this chart I just wanted to add in. You guys can take a screenshot; it'd probably be easier. But this is just.
We do have a chat in the chat. Sorry, Eric. We do have the to book a call with a one-on-one consultation if you're about your specific situation. Go ahead, Eric. Sorry.
Beautiful. Yeah. Perfect. So this I just put in so you can see over time that commercial multifamily versus the S&P 500, it actually destroys it. So if you are using this as an investment vehicle for retirement and you are concerned that it will not have the returns that the stock market does, it has way bigger returns than that. That's really the only point I wanted to make this. If we got into the numbers, it'd be too much in the weeds a bit. So then I wanted to go into a current property that we have. I don't want to get too much into the spreadsheet, so your eyes don't gloss over. But this is a property we have listed. You can find this on realtor.ca currently. We have a purchase property price of 1.2. You are the property, or the plan for this property, as we have. Sam, I just want to confirm you can see the spreadsheet.
Yep.
Perfect.
Just let us know in the chat if you're not able to see it. I think I can see it perfectly. So.
The plan for this property is, as we can see, currently it is very under rented. There are a couple vacant units. The idea is, and for most of these projects in Ontario now, since we can only raise rents around 1.8%, that has led to property values soaring a lot faster than the rental rates. So the ideal situation would be to turn over the tenants, get more income for those units after they are renovated, bring it up to current market rents, and refinance the vast majority of your money out. So we purchased that at 1.2. We're putting around 200 grand in to turn over the building, and our new value of the building is around 1.8.
So Eric, if they did not turn over, let's say they just made some upgrades to increase the value, maybe high efficiency toilets, and maybe one tenant turned over, should they still refinance that building after, or should they wait till they turn over all the units? What are your thoughts on that?
That's a good question. I would probably wait until you turn over all the units. The reason being that once you go into energy and high efficiency toilets and energy audits, that's actually a decently substantial cost. So if you're only turning over one unit or doing cosmetic improvements and not increasing the income to make up for it, that doesn't really work for your strategy at all.
And does it depend on the strategy, the type of property, to know ahead of time that this building will be easier to turn over? And what's the timeline, and how do you think that your team would be able to accomplish that?
100%. So some of these buildings we will find vacant. I will say they are more rare. Once we get into those, the timeline for that, depending, that could be anywhere from 11 months to 18 months, realistically, depending on how damaged the building is. If it's just going to be cosmetic improvements, obviously it's going to be a lot faster and closer to the quicker timeline before we can completely refinance. If it has been destroyed, there's mold all over the place, there's water damage, and that's a very substantial reno, you're probably going to the studs. That's going to be much closer to the 18 to 24 months. The tenant turnover can take, the tenant turnover can be more of a wild card as you're dealing with a human element and not just construction. Generally, we are seeing these projects go anywhere from 12 to 24 months. It really depends on the project and the tenants.
And we're not encouraging any type of turnover. We're just saying that there might be opportunities where there's potential to turn over and make a better living situation for that area and that property as well.
Yeah, 100%. So we usually know that in our due diligence. I mean, if someone has lived their whole life and they're kind of an elderly citizen, they're not going to want to move. So we can't really create a win-win situation there. So that might not be the best strategy for something like this. This strategy wouldn't really work for those types of retirement communities, let's say, where they built a whole community there. We usually don't want to touch those. It's just it just creates a no-win scenario.
So on a high-level overview, if you were just to describe this briefly for high-level overview, why should someone get started, maybe either their first or second multifamily property, and what would be the benefit of this particular project and this example?
So this particular project, it's a value-add project in Hamilton, and it's near it's one of the turning over areas. So it's not like a very great area on the mountain. It's more downtown. There's going to be more development. It's closer to the bayfront where they're pouring so much money building all the condos, etc. So that would be just for this deal specifically. That would be kind of the draw here. This is a purpose-built 6-unit. It has parking. It has laundry. So it's really a stable building to go forward into the future. If that is not kind of your cup of tea, then we would just have to find another property. And that's the importance of that first discovery call in order for us to really narrow down your criteria. Maybe you're not comfortable, investing in a B area and you really only want to invest in A's, then this building just won't work for you. So that would be another building we have to bring to your attention, and just a totally different strategy for this.
And when you mean capital out, does mean that they put their down payment and they get a little bit of their money back to invest again and maybe do this again and have someone else paying down that debt.
Yeah, exactly. So so realistically they would just do, I'm sure a bunch of people have heard of the BRRRR concept. So you can actually do the BRRRR concept, and I think it's actually easier on commercial properties. The bigger the property, the easier it is to get all of your money out. That's obviously going to require more upfront capital and more access to capital. It doesn't have to be yours, as I'm sure we all know. But if we are able to finish, a bigger property, those economies of scale start paying back in dividends.
Excellent. So if someone's getting started and they book a one-on-one consultation call with you, what can they expect? And if you could just go through that process a little bit, why that's important.
Sure. So they book a one-on-one call with me. Generally, we have a primary discovery call. And what that discovery call is allowing me to do is get your situation. So whether that means you are a super experienced investor and you're only looking for big projects, you already have the whole team in place, you've been doing this for years, and we just fill the whole kind of deal flow for you guys to purchase, all the way down to someone that, maybe they have a single family home, maybe they have a couple duplexes. This is going to be their first time in commercial and they need a lot more handholding throughout the process. So I really just have to, in that initial call, gauge where they're at, how much capital we have, what strategy can actually work for you, so we're not setting you up for failure and we're setting you up from success to the get-go. So once that happens and we introduce you to one of our financing partners, so we make sure that we actually have the ability to purchase and close on the building, that would be the second step. And then the third step is just off to the races. We find a property that works for you, get it under contract. I'll do all the due diligence, walk through, make sure it's a safe investment, that make sure you're comfortable with the investment. All the due diligence is done up front for these properties. We get everything. There's a lot more bills. There's a lot more rental income statements. There's a lot more due diligence that goes into these, just so you make sure you are making the right investment for yourself or your family over the next 5, 10, 15, 20 years.
Awesome. So if someone's getting started in investing multifamily, they have a building already or a multifamily property, what would be the big benefit of having a multifamily property? I know we spoke about it, and yet what's your opinion on that? It seems like to some people there's more families, there's more things, there's more tenants. What are your thoughts on that?
Yeah, so there's a lot more income, so it's less risk for you. Secondly, as you mentioned, you glossed over lightly in the initial introduction. Like, say there's, if we own 10 single family homes, there's 10 furnaces, 10 roofs, 10 driveways, everything like that. In a single building, there is probably one boiler. So if that goes, it's one fix instead of 10 furnaces. There's one roof. So it's just a lot easier to plan for those expenses. It's a lot easier to scale up to have property management actually manage your building for you. None of us got into this to work a full-time job and purchase a property and get tenant calls at 3 a.m. So it's a lot easier to scale up with the income to actually include these professionals that take a lot of the stress off of your plate. Secondly, it is very easy it's easier to add value here. Since it is based on the income of the property and not really comparables, if we are able to increase that income or reduce the expenses, that disproportionately increases the value of the building. So that could be as simple as charging people $20 for parking in 6 parking spots. Whereas you can't really do that in a duplex. We could have coin laundry in there. We could have, we can rent out sign space. We can have internet deals where we where we get a deal from Bell and then charge the tenants a discounted rate than they would get on their own, and then we just keep the spread there, and that would actually keep the income of the building. So all these little tricks of the trade would increase the value of your building, where a duplex is a duplex.
Yeah, and it seems like you even $100 to $200 a unit, if you had a 15-unit building, that would increase the operating income. And based on the cap rate, which you can look up online, or we can send you a report on CMHC, housing report, they have the different cap rates in different areas. So it seems like you can drastically improve the value of that property just by making improvements like that. Yeah,
so we'll just do a super simple calculation here. So
that'd be great.
Say we are able to increase the value by, let's do $10,000 a year. And this could be a combination of parking per month. This could be a combination of parking and laundry. This could be a combination of putting utilities on the tenants. In a standard 5 cap for the area that I'm in right now, that actually raises the value of the building by $200,000.
Wow.
So you increase income by 10, but your actual equity is $200,000 in equity. If you increase the cash flow on a duplex by 10 grand a year, you are getting basically nothing.
Yeah, and to the point with Canada having 500,000 immigrants coming to Canada, we have lots of people come from other markets, likely renting, increased demand for rentals. This is going to be a great asset to have and in demand, which won't be affected by market values as much because it's all based on income.
Yep, 100%. So there's always going to be a need for renters. We always don't have enough housing. The current blip we're in, based on the increased interest rates, is slowing it down a bit, but people still need a place to live. If their interest payments are too high now because they're raising interest rates, they can't afford a home, they're not going to go homeless. They're just going to find another place to live, and that could be your apartment building.
Yeah, it seems like also in your comment as well as creating generational wealth. Can you tell me your perspective of that, creating generational wealth using multifamily? Like, how would that be able to generate generational wealth for someone's family?
Yeah, exactly. So, over the period of owning this building, you're going to have a lot of mortgage paydown just based on the value of the building and the value of the mortgage on it. So, this may be, depending where you are in a stage of life. I know I'm fairly young, but if you're a family, you're getting your first investment property to pass along to your kids, the value of that and the cash flow of that will increase over time. So you can do the mortgage pay down now, and then when your kids are ready to go to college, or they need their own house in the future, or they want to do a 6-month sabbatical around the world, you can pass that wealth that you've developed over time onto your kids, and set them up in a way better financial position than you could actually currently.
Yeah, and the great point too is if someone had a few properties and they refinance them, you can refinance over and over every few years. You continuously get money out, and you can always improve the income at some point, and then you can also service that debt.
Yeah, exactly. I mean, appreciation over time is going to go up. Rent rates over time are going to go up. You take that, you build a lot of equity in this building, either through forced appreciation or natural appreciation to mortgage pay down. You can take that by a new property. So now you can have an apartment building for one child and an apartment building for another child, or any combination of the two, right? So it's a easy stepping stone to build generational wealth. It's not get rich quick, but realistically, it is get rich for sure.
Thanks so much, Eric. I'm just going to make sure your information is here in the chat. So if you'd like to get our guide on buying multifamily property, book a call with Eric. We'll have a free gift for you there. And he's happy to help you with your individual situation. If you need financing help, accessing the equity or the dead money in your home to do this, it's a great time to consider it. Anything you'd like to add, Eric? Thanks for having on.
Yeah, even if you're not ready, like you don't think you'll be ready to buy your first investment property in a year or two, or you just want to, you just refinanced but you want a current valuation on your property, I'd still love to help you. So feel free to reach out. No problem at all.
Thanks so much, everybody. We appreciate you. Thanks, Eric.
Thank you very much. Thanks for having me.
Thanks so much. Have a great day, everybody.